banks are going to kick us off in earnest when we get to earnings season next month. As you've been talking about, earnings had helped earlier in the year. Financials, though, pulled back by about, more than 3% as maybe some of those expectations around the yield curve came back in. What are you expecting, as Brian's kind of highlighting there, maybe some of the sentiment once we move further and further along into earnings season?
Well, look, we think that the financials, and not only in the US, but also in the rest of the world, especially in Europe, that were supported because you have on one side a strong economic recovery, very low default rates. I wouldn't look too much at the yield curve because the yield curve, this phase of the cycle, tend to flatten anyway, and you still have decent valuations. So I think when we look at the cyclical space, we're getting a little bit more cautious on cyclicals. Financials and banks in particular are the one that offer the best upside. I would say probably more in Europe than the US right now, but I think the argument, or let's say the supporting argument for banks is still very solid, and I think the earnings season will give another boost to the sector.
I think you said European banks over US banks. Did I get that right?
Yes, because we think that currently, when we look at the economic momentum, is actually much stronger in Europe, because Europe is 3-4 months behind the US in terms of the business cycle. In terms of vaccination, maybe a little bit less. We have, I think, a much bigger upside in terms of bond yields in Europe than in the US. And I think a lot of the kind of tightening of the Fed, at least in terms of guidance, is already priced in, which is not the case, I think, for Europe. So I think that European financials at this stage of the cycle tactically offer more upside than US banks and financials.
Any particular names that you can point to?
No, we don't look at the single name. I would say, though, that continental European banks, the ones that are more focused on the domestic recovery, are the ones that are more interested to us. They're also good value. And I think so when we look at Germany, France, and Italy, the continental European, the traditional bank seems to be the one that could have the biggest upside, just from a tactical point of view, because in the long term, I think the upside is much more limited.
Yeah, when you back up and maybe look at the broader market here outside of financials, the earnings picture does seem like you're saying that expectations have caught up with kind of what we saw last quarter. So maybe not expecting to see big pops or big drawdowns in terms of the stock reaction. So I mean, how do you figure things are going to go if that is the case, if people are adjusting their forecast now?
I think there is still upside on earnings, because I think we shouldn't underestimate the operational leverage of a lot of companies that we have in the index. So I think earnings is a price on the upside, but the surprise element is going to be much less. And so I think on one side, the valuation at 21.4 earnings in the US is very stretched. So what I think we need now is, I think, an even a further acceleration in economic growth, which I think is difficult to see. And this is why we are becoming a little bit more cautious on cyclicals on the market in the short term, because a lot of the good news is already in the price. And I see that it's difficult. I find it difficult for the economic momentum to get even better given where we are. So I think we're entering a more volatile phase where you have to be more selective. And I think for us, being invested outside of the US now offer a little bit more upside in the short term.
Yeah, it's one of those things we've gone back and forth on, especially now. I mean, we were just discussing kind of the Delta variant here and what that might do in terms of renewed lockdown. And energy, I suppose, might be one of those sectors that could potentially, we already saw, kind of take a big hit yesterday, potentially maybe on some of those growth concerns. If you do see more economies, emerging markets maybe lean off the gas pedal in terms of coming back. I mean, how does that maybe weather or change your look at energy, and how should investors be managing those expectations now? If it's second to financials, or financials is 2, energy is 1 on the year, how would you see it playing out?
I personally think that there is more upside in financials, because I think when you look at financials, the main driver of financials is basically interest rate. And I think if we are right in our analysis that the global economy will remain strong, and yes, will remain strong, the Fed will like probably a little bit more than expected. And I think the same situation can happen in Europe. There is an obvious catalyst for banks to do better. For energy, it's all about the oil price. The oil price is dependent on growth momentum and the dollar, which I think probably now are not as supportive as before. The price is already high. And I think from this point of view, I think we still like value as a style. but we still like financials much more than energy because we see more, let's say, reliable and fundamentals in the short term. And in terms of the variance, the one that the risk that you mentioned, I have to say that it's very difficult now to guess what the variant, what the damage will do. I think the evidence from the UK is that if you are fully vaccinated, the impact is minimal. But obviously, we have to wait to see for more evidence.